All right, E-mini S&P. I mentioned that we had the buy side liquidity pool here a week ago or so, and we ran up into that, obviously. We have a volume imbalance here, and we have a volume imbalance in here. Ran up, failed to go above the high. Today we had a little bit of a give back. These two volume imbalances, while I don't have them noted, you want to have them both annotated on your daily chart and extend them through price action for Thursday and Friday's trading, because those levels may be impactful, and you don't want to just do a like one big bulky area. Don't use the highest high and the lowest low of the volume balances, collectively. Do them individually and then label them respectively in your chart. That way, when you watch price action, if it responds to those levels, and I'll explain what that means, what it would look like, they're going to behave just like the new week opening gap, which is what's being shown here on the hourly chart. So the S&P hourly chart, Friday's close, that's what this level is here. The Friday closing price and Sunday's opening price, make sure that's on your chart. Then whatever that range is, every new week, and you do the same thing every time there's a gap opening. So when we close our session at 5 p.m. each day, Monday through Friday, or not Friday, but Monday through Thursday, when we open again at 6 o'clock, when there's that 1 hour gap of no trading, you want to do the same thing I'm teaching you to do with the new week opening gap. Use the closing price and then the new opening price at 6 o'clock. And then that range, divide that in half and extend that throughout the next 12 to 16 hours. And that right there will also act much like you see with the new week opening gap. 15-minute chart on ES. This high, you want to put your Fibonacci on the closing price and the high and get the 50% level. Then take your fib and place it on the 50% level down to the close. That new 50% level is 25% of this wick. That's what this level is here. Go down to your lower time frames and you'll see, much like you see over here, look how price is sensitive to that. Hits that level, trades down. Now, how's that useful? Why is it even useful? Because I'm sure some of you are thinking, well, that's cherry picked. If you think that the market is bearish, and you're going to come to these conclusions in your own analysis in your own good time, if you think the market's not likely to go through an old high that has a big long wick like that, if it's extremely challenging for it to go higher, it will not likely do what? Trade the consequent encroachment, which is the midpoint of the gap. We're looking at these moments where the market is likely to do damage or trick, entice, lure traders in, go up and engage a pool of liquidity for buyers. If it meets a criteria that fits a narrative, why should it go up there? Well, if there is an entity that is collectively referred to as smart money, they will use that liquidity above an old high to get short and aim for what? An old low or an inefficiency below market price. And then they will offset their short position at a discount price, while those discount prices are being viewed by retail traders as, oh, this is our stop loss because we're trying to be long, and their willingness to sell below an old low is ideal for smart money that wants to buy at a very low price. That's how they cover their short. So when you change your perspective and you have that market efficiency paradigm shift in the awareness of how price is actually being booked, listen, it's not something they want widely understood. That's why it's not taught. That's why it's not shown, and that's why you're going to see resistance to it, because there's a lot of people in this industry that don't want you to know what you're learning here. Too fucking bad, because it's happening. So back to the S&P. This quarter level of this entire wick, that right there, you want to study that, okay? And in your notes, in your journal, like something up in here in this area here, you want to write that when there is a heavy bearish stance on price, consequent encroachment of a wick is likely not to be traded to. If you suspect that is the case, you get the very specific price level of 1/4 of the wick. Don't take my word for it. Go back through your charts and your jaw will drop. But with that said, the market trades below this short-term low here, breaks lower, and then we have the classic model 2022 that I taught last year on the YouTube channel. Market trades up into it, sells off, consolidates a little bit. We go into the New York session with relative equal highs here. That's buy side. Now, here's one of the things that you also will feel uncomfortable about. You're going to look at certain candles that I'll refer to, and you're probably looking at this and saying, well, why didn't you use this old high here? Well, look what happened. We have a SIBI here. The market's repriced up into essentially what? That entire range here. And then we left it. So what is this becoming? A balanced price range. But we have to factor in time of day. So everything that's being shown here on the 15-minute time frame, go over here to the 5-minute chart. Suddenly things become a lot more clear because you can see now here we have 1, 2, 3 times the market has provided what? A smooth edge. So what happens is these smooth edges that look like resistance to a retail trader. So you're asking me, why am I not using this high here when I've already explained that? What I'm teaching you is once it's already done its work here and then it creates a lower level of smooth relative equal highs, 2 highs, now you have 3. What's the retail crowd going to think about that? Oh, that's strong resistance. So therefore they can think what? They can go short and put their stop loss, which is what kind of stop? A buy stop. So they're going to try to go short. The market provides them the reason to want to go short. What's above here? Buy stops. So the market does what? It rallies up, fails to really bump through it much here. So what does this look like? That's a quadruple top. Man, we got to write a new chapter in the books now, right? So they're thinking it's really, really strong resistance. They drop it down. They drop it one more time, take out the previous low here. Everybody's on board now. They think it's going lower. And then where does the market go? Run right back up, takes out all this buy side liquidity. Well, because it has created this relative equal high here, and it runs up into it here, once it does that, you're in a deep premium. You have a huge pool of liquidity here with real buyers. Why didn't that send it higher? Because it isn't designed to do that. It's only going to go up there and trigger those buy stops. So that way, smart money, the collective entity that does what I'm teaching you to do in price action, they're going to go in and gather up all that liquidity to be counterparty to go short. They're going to sell it to those buy stops. And once it cleared these relative equal highs, then it was off to the races. Real quick, sudden decline. But now let's go into a lower time frame chart and take a closer look at it. Here's that same zoomed in area where buy side liquidity is resting here. It only bumps up to it right there like that. Once it hits it, does it spend a lot of time waiting around? No. Market reaches lower. And while we're inside of this area here, we're still at a premium. So I'm going to show you how we can use the PD array matrix to map out a premium to discount market in a implied dealing range. This is the part where you take notes, folks. All right, so we're zoomed in that same area here, but now on a 1-minute chart. This is the PD array matrix. From this high down to the 41.46 even level. Now, why am I referencing that? Because that's the target I told you the price was going to go to today, this morning. It's going to return back to what? The new week opening gap. It's going to be like a magnet, folks. It's going to want to draw back to that. Why? Because for the week, for the entire weekly candle, from between the highest high and the lowest low, if it's not a trending market, what's it going to do? It's going to treat the new week opening gap as fair value. And it's going to want to revert back to that continuously. The algorithms that operate on the fund level, they will likely use that opening gap to constitute their new trade idea based on a new sentiment idea because it trades back to it. So if it's up here, and I'm telling you all, focus on 41.46 because it's likely to pull back to that weekly gap that opens on Sunday. What's the nearest price above the gap? It's the Friday's closing price, which is 41.46. So if that's the level we're looking for price to go to, and we're above it, and we're looking for lower prices. We create a high here. It starts to pull back and go below the high here and the relative equal highs that we've had now 4 times. 4 times it banged into that level, and then we hit it here and then started to sell off. Where are we at when price is trading right here? Are we in the red area, which would be considered premium relative to the high, to the target where we're looking to trade? They ran the buy stops above those highs. Ran it right up in there. When this thing starts to break down and we have a target, 41.46, you need to take your high, if you're short, or if you're looking to be short, the high that forms that you think is a suspect high. A suspect high is a high that's been blown out, and you want to see if it maintains the rejection. So we don't know if this high is going to be, well, taken out, if you will, until we trade from premium to discount. We have that right here. Then the market does what? Returns back up into a premium. Here, what's occurring? Look closely. I'll take the annotations off in a second, but look what we have here. We have the high to 41.46 even, which is the Friday closing price, which is the high end, the top of the new week opening gap. With that price level as a magnet, if price is up here relative to that target and the high is here, if we go short in here, we're shorting what? At equilibrium or premium. Either one is okay. But you can't go in and start pyramiding once we get down into here. Because once we start crossing into the halfway point of the discount level, you're too much in a discount to add more to it. So here's the level. That's equilibrium. Do you see the volume imbalance right here? I've been teaching it. That volume imbalance is at equilibrium and then a very small premium. My entry was short, instantly delivered. This type of movement right here, that is exactly what a low resistance liquidity run signature performs like. Now, do you want to be in a move like that, or do you want to be in a move like this? Buying down here, hoping it gets to this level up here. Buying here, riding it, rolls all the way down this deep against you, rallies up. Okay, it's going to give it to me. It's going to give it to you. Nope, it rolls back against you. If you put your stop here, you're taken out. Then it rallies up here, but you've been taken out. But it went to your target. Look closely. The volume imbalance here. Why am I even looking at that? Because of everything I just outlined, how fast we move from this high. It's not likely to do what? Come back up to any of this imbalance. It's showing us what? Volume imbalance here, a fair value gap, another fair value gap, another volume imbalance that did what? We traded up into it here with that little bit of a wick, and we went down into discount. Halfway between the high here and the target of 41.46. So I know some of you are thinking, okay, this is really complicated, ICT. It's not. It's only because you're seeing it explained to you for the first time. This return back into that volume imbalance right there. That's it. That's it. That's the last bus stop. And then we're out of here. Elvis left the building. When nobody else up here was expecting that price there. So the narrative was run the buy stops, accumulate that as a short position for smart money. So the composite man sells short to the buy stops and buys the sell side liquidity to cover the short. And the market rallies up to some random level between this candle's low and this candle's high, which is consequent encroachment. That's exactly what you're seeing right here. And the market trades lower. So the market trades down to midpoint, rally, midpoint, sloppy, 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 sloppy. And then between 10.50 and 11.10, there's going to be a macro. I already know some of you are thinking, okay, but you said at 10.50 to 11.10, and then there's 11, there's 2 of them, okay? What did I teach you with Forex? What happens between 10 a.m. in New York local time to noon New York local time? What time of day is that? That's London close. That order flow that comes in at that time you're going to have a macro that occurs at the 10 o'clock hour and the 11 o'clock hour. Then at noon, between 1 and noon, New York local time, there's an algorithm that runs there too, which returns us back to what? The morning stops. So between the 10:50 and 11:10 hour, there's a macro that will form that makes a run on liquidity that has not been taken yet. What does that look like? We have the market rally up and then breaks a short-term low here, relative equal lows, trades down, and then creates this fair value gap. It's a gap, yes, but what kind of gap is it? SIBI, S-I-B-I, sell side imbalance, buy side inefficiency. So what is it lacking? Delivery on the upside. So it overshoots it here. That's fine, no problem. Small little gap here. If there's a gap like that, your stop has to refer to that as well. Remember, if there's two fair value gaps, your stop has to at least respect that higher level fair value gap. So when you have two fair value gaps, your stop loss has to respect that. And that means you have to do what? Use less leverage. So in this imbalance here, it rallies up into this small little fair value gap here. And then we have the move lower. We trade down to the low here, rally back to the midpoint, break lower once more, sell side. So every instance of London close between a 10 o'clock hour and 11 o'clock hour and noon, there's several things that occur that are algorithmic. I'm going to give you specific details about what you're looking for, when it should form, what times and what days is it not likely to form, and disregard it. They're usually trending days. Trending days, you're not going to see a macro. It's just going to be like, boom, goodbye, off to the races, and it's not going to be anywhere seen. But how many times do you see that in trading? It's not a lot. So most of the time, you're going to see certain little quirky things that repeat, and you can trade with them. You're going to find that they themselves can be your entire trading model. So what does that mean? You can schedule your business down to a 20-minute window. What? Yes. Yes, Dorothy, we are no longer in Kansas. Okay, we're in the wonderful land of Oz. So anyway, the market comes back up, fails to come back up, and falls short of the closing price on Friday. And then big surge lower, trading down into the low that Fibonacci from the high down to 41.46, pretty much nailed that. And then we traded into some sloppy conditions going into the afternoon session. Now, before I go on to the next slide and close this discussion, if we know that the market has traded from the high here, lower, what is the lunch hour going to do? It's going to run on what? Buy stops. So buy stops during the morning session, where would they most likely be? Well, you have this here, but we don't have a whole lot of interest in something so shallow like that. Also, what did I tell you to look for throughout the entirety of the week? If there's an opening gap on Sunday, you extend that through the entire week. So are we interested in just running these here? No. What high is between the gap that's formed on Friday's close and Sunday's opening? This high here. So 41.46, that's the morning high. Why? Why am I going to pick that? Because it has to do with that weekly gap opening. The market's going to want to do what? It's going to want to draw back into that. So who's making money right now at this time of looking at the chart right here? Who's making money? Shorts. So where's their stop? Yes, they're right here, but more specifically, they're right there. Because this high is forming when? At noon. You're already in the lunch hour. You're already in the lunch hour. That's not a high that runs the AM session high. I'm not saying the highest high. I'm saying the most recent high. Because why? Think, folks, think. As the market's dropping, if they're short, what are they trying to do with their stop loss? Jam it down to the next relative high. Because they don't want to see that high taken, so their stop loss is going to be put just above it. So that's why you're going to focus right here. When you're looking at price, you have to think about who's in that trade. How are they managing that trade? What is the worst case scenario for them on a nightmare level that if they think it's going to keep going lower, they don't want to see their high taken out. Even though they have their stop loss there, they don't think that's going to happen. Well, ring in the lunch hour. Here's the noon hour beginning. That's that short-term high. I said we're not interested in that. We're looking at that high here. So this high has AM session buy stops. So between noon and 1 o'clock in the afternoon, all of this movement here, this is a high resistance liquidity run too. It's a lot of roller coaster ups and downs, ups and downs. And where does it go? Ultimately, right where I mentioned, it would see logically the AM session most recent high that would be considered a high for trailed stop losses while the market dropped in the morning session. They're absolutely leading you into the slaughterhouse. You're following all this Judas theory. So the buy stops that are resting above this high here, we run through that. Where? Post lunch on the other side at 1:30. 1:30's here. We're missing it by, that's a minute or two. One more time it runs it. But look at this high here. Go over to this volume imbalance right there. This candle's opening price, which is the low of the volume imbalance. That tick is the very tick high of that candle right there. So how far can it go above this high to run the stops? Well, look to the left up. What do you see? You see this wick. Consequent encroachment is just above that. That's not reasonable. If it's going to run there, it's going to run a little bit higher. So that means it's going to go above this. So what's above that? Volume imbalance. Bam, hits it. Failure. You're thinking bull flag. You're thinking it's going to continue higher. It's not. Only thing it's done is reverted back to that weekly opening gap. And it's broken above it here to do two things. Take out the stops here that were trailed for shorts. And induce new buyers that think of that opening gap as a breakout. So now we've done what? We went below it. So now if we can get back above that opening gap for the week, large funds will come in and they'll buy that. So they're doing what? Buying on a stop. They're buying with the expectation it's going to continue higher. All the way down into here, cleaning up all this inefficiency. We have sell side below here, 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 and stacked heavily at the AM session low. Small little fair value gap in here. Mean between the high and the low. So the middle part of that is a consequent encroachment level. Trades right up into it here. Beautiful delivery. Fair value gap. High to low. We're in a premium. Think about that dividing of the range. From this high to that low as it's retracing, we're in a deep retracement. Do you need to plot a Fibonacci on this high to that low to see that we're not already in a premium? Your eyes have been trained to it by now. So the only thing you're using Fibonacci's for is to find out the exact price for the mean threshold of an order block or consequent encroachment of an imbalance or project targets. This is optimal trade industry. This is OTE. That's the flagship pattern of my channel until I guess the 2022 model was given to you last year. The market breaks down below 41.40 and a quarter, comes back up, hits it, fills in a fair value gap there, breaks lower, small little imbalance here. Incidentally, this wick right here, and we're looking at a 1 minute chart. So this wick right here between 4:15 and 4:30, that wick, find out what that consequent encroachment level is on that, the midpoint of that wick. Extend it through this fair value gap and you'll get the very tick high of this candle right before it drops down. Yep, that's one of my favorite pet entries. I love that one. I love it. And it'll serve you well when you know what you're looking for. It's a perfect to the tick delivery on that candle, and then suddenly it delivers. Goes lower, trades back up into old order flow here. One more time. What do you see here? 1, 2, 3. Breaks lower. What's below these relative equal lows? Sell side. So the market went up here for buy stops, then ran down below these lows that was engineered, starts rallying. Someone's going to buy that. They see this is a bull flag. It rallies up. Oh, it's going to break out. It's going to trade up to here. Even if they don't think it's going to break out, retail logic thinks, okay, this is resistance, so hold it until it gets to that level because that's our target. They're not thinking trade up and through it. They're thinking it's going to go back up here. It's got room to still rally. No, it doesn't. We're stalling here, turning, then attacking the sell side that was engineered with these runs higher. Buyers are going to have their sell stop below that, which is convenient for the smart money that's selling to the old buy stops here. They have a net short position. Smart money's net short here. They add here. They take some off here. Rallies back up, fills in an inefficiency. This high here falls just one tick short of consequent encroachment here. Trades below these relative equal lows. What's below that? Sell stops. Why? Because the market rallied up. Somebody's going to chase it. They'll chase it and buy it up here and put their stop loss down here. You don't think they can do that or think they won't do that? Look at social media. They're doing it all the time. The market drops, attacks the sell side here. That's a partial, and then bang, right below the morning session low. Smart money sells short, adds the shorts, takes partials, adds the shorts, covers at terminus below the morning session low. And then, and only then, the market goes back into sloppy choppiness, getting ready for another day of the slaughterhouse on Thursday.